What's the difference between an LLC and an S Corp? Both are passed through in terms of taxes, meaning that you don't get taxed at the entity level, you get taxed at the individual level for an LLC or an S Corp. They are both actually LLCs. An S Corp is just an election that you take once you're an LLC. They both afford legal protection. That means you won't get sued. People won't come after your personal assets if you're protected. You have that level of protection. You have an LLC or LLC filing as an S corporation. Now let's get into some of the differences. Now, an S corporation is partly not subject to self-employment tax. Difference, an LLC, all income will be subject to self-employment taxes. Now, as an S corporation owner, you take what is called a wage or a salary. As an LLC, let's say a sole proprietor, you won't take a salary, but you will take distributions entirely. Now, let's get into this. Both are taxed on the net income. That means the gross profits, and then you subtract the expenses and all other deductions. You get to the net income. That is what is actually going to be taxed. You take the net income, and you're gonna have to be subject to federal and state income taxes. And in addition to that, you will have the self-employment taxes of 15.3%. Now, there is a Social Security limit for 2022 of $147,000. So you would have to pay up to 15.3% to the $147K limit. And then after that, whatever is above that, you would only be subject to 2.8% of Medicare taxes. Now let's get into an LLC sole proprietor. Let's get into this example. You will have higher self-employment taxes. All net income from the sole proprietor LLC will be subject to self-employment tax. So here there is no chance of differentiating between salary and an owner's draw. Now, with a S corporation, the part of owner's draw is not subject to self-employment taxes. That's the key there. Now let's get into the S Corp. The S Corp, in terms of the self-employment taxes, that is only for the wages paid to the owner. The owner draw, again, the part of the net income that is retained within the S Corp will not be subject to self-employment tax. Now let's get into this scenario. Let's say it's an LLC sole proprietor and the person is going to file as single. Let's say that we have a net income of $140K. Well, the self-employment taxes will come up to $21,420. What about the federal income taxes? Well, let's say it comes up to $24,328 here. That would mean that the effective income tax rate is up to 17.37%. And then we take the self-employment tax rate, which as we saw, it's 15.3%, for a total of 32.67% that you will be taxed. And you know that is even before any property taxes, sales taxes, and other kinds of taxes. We will get a total of $45,748 here. Again, this is before any state sales and property taxes. Now let's switch it up and have the scenario of an S corporation. Let's say that you have the same amount of income for $140,000. Let's say that you were able to take a salary of $70,000, and then the other part, you have it as a distribution of the same amount, $70,000. Well, you would have self-employment taxes of $10,710, and that would give you a total savings for the self-employment taxes of $10,710, because we're really splitting it in half in this example. So again, you will annually save $10,710. What could you do with that? You could pay down debt. You could pay down credit cards or any other kind of debt you might have. You can pay down your mortgage. You can dedicate that to donation, service, whatever capacity. You could reinvest it into your business. You could invest into a separate portfolio, a separate investment portfolio. You could also take a vacation with your family. All kinds of things you could do with that kind of saving. Now, let's say, okay, we have a yearly saving, $10,710. What would happen if you would invest that at a 10% growth rate over the next 30 years? So you are putting that amount of money you're saving annually, you're putting it into investing, and it's growing at 10% a year. What would happen after 30 years? Well, you would be a millionaire. You would have almost $2 million, so $1,755,000. Now let's get into some of the S Corp requirements. Okay, so again, owners must pay themselves a reasonable compensation, and it must be based on different kinds of factors, including can be training, experience, the position, duties you might have within the company, comparable businesses, what they're paying for same kind of roles. You may use a formula to determine this and other factors as well. Now, it must be a domestic corporation. It must have no more than 100 shareholders, and the shareholders must be U.S. citizens. They cannot be non-resident aliens. And you can only have one class of stock. However, that stock can have different voting rights. That's allowed. Now, all stocks of the S Corporation must have identical distribution and liquidation proceeds rights. Now, the profit and the losses of the S Corporations must be allocated in proportion to each shareholder's interest. How would you elect to be an S Corp? Well, you must file Form 2553, election by a small business corporation, no later than 2.5 months after the start of its tax year for the election to be effective. That means you must file that form by March 15 for it to be applied to that same tax year. Of course, if you want to do all this, you want to explore if this could be a good avenue, a good thing for you, you can contact us. We are Odyssey Accounting. Go to our website at odysseytaxes.com, and we offer free consultations, and we can take a look at your situation and see how best we can help you. So again, go to odysseytaxes.com for a free consultation. Thank you.